I want to sort of pivot, Rohit, now to a broader trend which we witnessed this entire calendar year, and that is to do with the FPIs pretty much dumping Indian equities. In fact, 2025 has now become the year of foreign investors selling equity, both Indian equities as well as Indian bonds. Now, as per a report by the Hindu Business Line, out of the 234 trading days until December 12th, FIIs have been net sellers on 141 of those trading days, with this figure being all set to exceed the 146 net sell days recorded in the year 2022. And till date, the highest number of net selling days in India in the last 2 decades was recorded back in 2008 financial crisis, when the sell days rose to 154. Now, net outflows till December 12th had increased to more than 1.5 lakh crore rupees. In fact, 1,52,273 crore rupees. Now, when distributed across all trading days of 6 hours each, this figure indicates that around 110 crore rupees exited the Indian market every trading hour this calendar year. Now, this selling peaked on December 10th when FPIs pulled out as much as 5,386 crore rupees in a single day. Now, multiple reasons behind this. Rohit, I want to understand from you, one of the reasons that seems to be is the sharp depreciation of the Indian rupee, which has weakened to record levels in recent weeks, which has further dampened foreign investor sentiment. So, in your opinion, do you think there should be a little more RBI forex intervention to arrest the fall of the rupee, at least in the interest of FPIs staying committed to the India story?
No, I think that's a circular argument, because, what causes the currency to weaken? Is it the FPI selling that causes it to weaken, or is it the weakening that causes FPI selling? So, we can go in circles on that. So you have to really come down to the fundamental situation as to why the rupee is weakening right now. I think the RBI used to intervene a lot a year or two back, and to some extent we would call that over-intervention. I think we are in a situation which is much better. You need to allow it to weaken a bit, because otherwise it gets excessively strong against competitors. And in the current environment where we still have those tariffs on us, it's actually helping exporters to some extent, getting a weakening rupee. But now if you look at the underlying, our current account deficit, which used to be over 2%, 5-8 years ago, is now had gone almost to 1%. It's risen a bit because of the tariffs, but it's still well below 2%. So in that sense, we have a much better reserve position. We have a much better current account deficit situation. So that's not really the cause of the weakening. But definitely in the near term, you've had high gold prices. So that does result in gold demand, gold imports, which often affect trade flows and the currency itself. And of course, FPI flows, which have been weak because they've been supportive of markets historically. But for a long time, we've not seen that. And we also need to look at, when we talk about FPI flows, you have to net it off against how much money is really circulating out into IPOs. Because, when you look at CDSL numbers versus the daily NSE data, sometimes the outflows are not that big. But still, it has been a net outflow year. There is no doubt. But a lot of money gets circulated into IPOs as well.
Right.
And that's also the reason why we saw the mid and small cap selling last month, which was a lot of IPOs getting allotted, and people had to sell stocks to make those investments. So that's part of the pressure point that we've seen recently.
Right. So interesting, this entire circular conversation around whether it is the FPIs which are leading to the decline in the rupee, or a weak rupee which is leading to the exodus of FPIs. But also, there's this question of rich domestic valuations which are making India relatively less attractive as compared to other emerging markets, which are potentially offering better value to foreign investors. So do you think it is time, as we come to the end of 2025, you're on the verge of entering 2026, is it time to revisit the discussions around frothy valuations, especially in the small cap and the mid cap space that you were talking about some time back?
So it's a very bottom-up call. We've been scanning across stocks since we've started providing research services, and what we're actually doing is we're looking for segments and sectors where valuations have come off during this consolidation phase between 24 and 25. And I can tell you that there are a handful of such places where it's happened. In fact, if you just look at in the big caps, the biggest performing sector has been banking. At the start of 2025, banking stocks were at the lowest valuations that we had seen in a decade. And that's sort of what has driven money back from funds who've been consistently receiving the SIP flows, have been allocating more and more money to financial stocks. And so that's a trend we very, very clearly seen. So the simple point I'm trying to make is there are many pockets of low valuation within the average valuation. If we look at where the markets bottomed in COVID, it was at around 17 times historical P. Right now we are at closer to 19 times or 20 times based on that. And that's not very, very far off. The peak valuation for Indian markets has been closer to 30 times. I'm talking about the Nifty itself. And we are not there. So the valuation argument has to be sector specific and stock specific. I don't think this is an extremely overvalued market.
Okay, and which are the sectors which seem to be dealing with that high valuation right now? And do most of these pertain to the small cap and the mid cap space?
So within mid caps, it is stock specific. I think at a sector level, most would appear corrected because we have seen sell-offs in, say, power, energy, everywhere. I think almost every segment we've seen some kind of selling. And so if you look at sectors, you might not find significant overvaluation. In fact, you might find pockets of undervaluation. But when you look at individual stocks, some cases you'll still find price earnings at 80, 90 times, and some cases they've actually dropped from 100 to even 30 or 20. And we end up looking for those opportunities where the valuations have come off and growth is still persistent.